Hello, fellow traders. 'Tis I, the Rumpled One. It is Thursday, August the 16th, the year 2018. Let's talk trading, getting better. In today's emails that I've already started to look at, there was a couple of different emails on the subject of getting better. There was one from a sports psychologist or coach, where he talked about letting go of what happened the last time at bat or the last time, you swung the golf club or tennis racket. You just have to let go, especially if it was a mistake or a bad call or it didn't turn out quite the way you want. Then another one email I read was basically about how each and every day or every session that you're partaking in, and this is, I guess, in business and in life, you just want to get a little bit better at something. Pick something and try and improve. And one of his examples was playing guitar. I can relate because I play guitar. And he was saying how he kept, going from this style of music to that style of music, and as opposed to maybe just working on something where he could get better at, like maybe getting better at playing the G chord and all the derivations. So then when he found the type of music he liked to play, then he could, master that genre that much quicker because he was better at, some of the basics, like playing a simple G chord or maybe even complex G chords. So what's all that got to do with trading? I mean, getting better at trading, what would that look like? What would that mean? I think your knee jerk reaction or answer is going to be making more money, right? Some people might even think having less losers. But is that really getting better at trading? Maybe getting better at trading might look like sitting in front of the screen all day and not taking a trade at all. And it doesn't mean you missed opportunities. It just means that according to your plan, an opportunity didn't present itself. I mean, there's some people out there talking about systems. Oh, 15 minutes a day is all you need and you can find your trade and blah, blah, blah. But I think usually those are more like stock traders who are trading for the long term. They might sit in a trade for 3 months or something. And there's nothing wrong with that. But I think most of the people watching the videos that I make are probably day traders who might be in a trade, minutes to hours, maybe a few days, but not much longer than that. We have a much shorter, take profit horizon. So when you think about getting better at trading, think of some of the nuts and bolts. And one thing you guys should all be getting better at is your money and risk management. Yeah, I knew you guys knew I was going to segue into this, right? Because see, really, it's not hard. I mean, we've got basically, two equations. You determine your risk. You can either multiply your account portfolio by a percent, and that's how much, or you can just pick, some amount that you're going to that you're comfortable with losing if that happens to be a losing trade. And let's see, we've got the yen at 110.70. As you can see, we're outside of that lower monthly wick zone right there. In fact, we're about 15 pips above it. And you can see we're inside the weekly wick zone right here. And we still have two that haven't filled, and chances are this late in the week they're probably not going to fill. You can see here the Aussie New Zealand's down here. It has to get up there to fill. And the Aussie franc looks pretty similar. And you can see here, dollar yen is now leaving that lower wick zone. We've only got 3 pairs above 100. And interesting enough, the beast, the pound yen's only at 95. Euro yen's actually. Remember, I had spoken earlier, I think around the beginning of the month or the end of last month, I was saying I was really thinking about switching over to the euro yen. I think it's telling me it's time to switch back to euro yen. And those of you who know me from where the pirates hang out, us Forex pirates on that good pirate ship, know that the dragon made his name trading the euro yen. And looking at the buy zone here, why do I have that up there? There was a trigger short and profit to be had. There was a trigger long, and right there was your pivot point, small profit, trigger long, right there, small profit, trigger long, small profit, trigger long, small profit, trigger short, small profit. But each one of those triggers gave you an opportunity to take profit. Sometimes it's just a few pips, sometimes it's a lot. I mean, look at the range here. We've got basically hardly any range, 47 pips. And you can see here we exited the green rat zone into the red rat zone. And we talked about the pivot was taken out. And you can see here we took out that pivot. And the price action. Oh yeah, didn't I say I was going to let's just do that. We'll get rid of that. Let's see, not edit. We'll get rid of that one. We'll get rid of that one. Okay, we'll get rid of the PA and the turn trade. And we'll get rid of the lower window. And we'll just clean it up like that. And let's see, we can call that, whoops. And we'll save that template. But right now you can see 2 ball at the top, red at the line is profit. Right, actually down here, 1 ball at the bottom, green at the line, profit. Here we go, 1 ball at the bottom, green at the line, profit. The simplicity. Just simplicity. Nothing fancy. Just grind out the trade. Sometimes you get a little, sometimes you get a lot. But you don't have to do anything that difficult. I mean, you're buying and selling. All you're trying to do is determine the direction. And usually the H1 candle color's kind of helpful in determining the direction. And when you trade the same pair day after day, week after week, month after month, and sometimes year after year, the same instrument, whether it be a future or a stock, you can actually get good at it. But remember, getting better means you have to pick one little aspect and try to get better at it, such as waiting for the H1 candle to close before you jump in a trade sometimes. So for example, see, this came down here and put in, probably the one ball was here. So all you got to do is just wait for that candle to close. And then this candle opens, right? You had a 2 ball at the top. This candle opened and it pushed down. So you could go short here. And then it comes back, and right here, that's where you say, okay, I just need to basically scratch the trade for a couple of pips, because price is now going the other way. And then you see that 1 ball there. And then you just let that candle close. They didn't hit it. Then this one opened right there, the 110.70. You could have jumped in. Now, there's a couple other price action opportunities. This was a turn. So you put in a 1 ball at the bottom, red, green. You could jump in right at the open because that's a turn. Now it could have gone this way, and you take your chances, right? On the other hand, right here, red candle closes, green candle closes. You go high, you go long right here at that high. So when price hits this point, that would be a rat reversal. So you could have taken a turn trade at the open, rat reversal here, or just wait for it to hit the 70 and jump in. That's up to you. It's 3 different opportunities. Or maybe you could take all 3. Let's see. You stack on. 1, you jump in. 2, you add to it here. 3, you add to it there. And you can stack the trade, all using price action. And once again, H1 candle color at the line. And I've been corresponding with a couple of traders via email. I really prefer if you guys put those questions either out on the forum or in the YouTube video replies. That way more people can benefit from the Q&A, and somebody else might have a question, or they might be able to explain it slightly different than I do, and maybe you understand them a little bit better than me. Looking here just at the monthly close to open, you can see there's just been some huge, as usual, movements off of that monthly. So sometimes, when the month opens, price goes one way and reverses. Jump in on that monthly open, and you can ride it, all month, or maybe a week or days for those 100 a pip type trades. Or you could just simply stick to the wick zone every day, and every time it leaves the wick zone, you enter, and when it comes back in, you just wait for it to leave again, and you enter. Or you can do the holo. Here we go. Lowest open, nice run up, highest H1 open, then a nice run down. Dip back in here. You could have jumped in a second time, and there you go. So you can see here, it didn't close in here, it just dipped in. But if you're an experienced holo trader and you know you have stop losses in case it goes against you, you have no fear. You jump in right here, inventory reduction bar. There was a long, there was a short. And on the previous days, week and month, open, high, low. Once again, just trading at horizontal lines. You can see here, not much movement in the past few minutes. Einstein, there you go, one quickie. So, just remember, you got to get better. Pick one thing and try to get better at it. Maybe you pick one thing a week and you work on it each and every day. Because remember, fellow traders, it's not what you trade, it's how you trade it. So get out there and drain the banks.